Okay, welcome to the Cash and Common podcast. This is episode 5. We're pretty excited about continuing our conversations on wealth building, cash flow management, legal elements as they fit in with those topics. Here today, we've got a special guest, Tina Maric. She's here today. And, of course, I'm back with my good friend, Rob Palaccia. And, today we're going to try and get some specifics about investment strategies out onto the table, talk about them, criticize them, go deep into some of the things that Tina's working on. Tina is an active investor in Canada. She's also a realtor in Canada and in the Canadian market, but is also, interested in other markets as well, the U.S. market, which we may touch on here as well a little bit. We'll see if we have time. But I think the focus today is going to be on investment strategies and how you can kind of get involved in investing in the Canadian market, but also how you can do that in a down market. And also we'll touch on some of the problems with getting involved in a down market. We'll hit on some of the banking issues. We'll try and tackle a bunch of these issues, right, Rob?
Yes, we will tackle a bunch of issues. Yeah.
Yeah. So, listen, I think we should start off by sort of just getting a take from Tina, because I really think that, a take, and maybe Tina, you want to kind of give us a bit of an overview of what you're working on, and then some strategies that you think could work in Canada, and some strategies that should work, but they don't work because the Canadian market has, its nuances that make it kind of tricky. So maybe you want to just sort of give us an overview of that. What do you think?
Yeah, absolutely. So what we have been flipping condos 3 years ago, kind of expanded our flipping journey into something a little bit bigger. So we just finished a custom built home in a Etobicoke area, and we have plans ready, submitted to the city for another one. That one will be a 3,000 square foot home, actually a little bit bigger with the basement. And it's in Oakville, in my opinion, prime area for that. But aside from custom building home, we would love to experience long-term renting. We have some experience in it, and also some short-term rental getting set up.
Yeah.
So we are tackling different strategies, that's for sure.
So you've got to buy. So what's your main strategy with what's happening there at, I won't say the address of the property, but I'll just, what's happening there with the property that you've built so far? So maybe also so you built this property on your own, you and your husband built it?
Yeah. We actually poured our heart and soul into it. It's definitely hit. I was basically doing the interior design of the property. My husband is an electrician by trade, and I've been in construction since 15 years old. So he managed the project, and now it's finished. It's on the market. We are very, very excited about it, and we can't wait to find a buyer that will, call it home.
Yeah, and that's that's really going down the path of developing property, getting really involved in development. You guys are doing it, bootstrapping it yourself, basically.
Yeah. What was it when you originally bought it, or what did you turn it into?
It was actually a fire damage property.
Really?
Yeah. We kind of were taken by surprise, thinking it would be just a quicker kind of a flip, but obviously we learned quickly that it's not something that you can just tackle on like that. And so we hired all the consultants needed and took it on, and I've loved it every step of the way. I definitely loved the designing part of it. I always take it as building it for myself. So from the functionality standpoint, I was thinking and double thinking twice of what to do and how to go about things. And so I think it's a beautiful home. I keep on being surprised by it when I go in,
How did you figure it out? Right? I mean, I feel like, yes, your husband has been involved with trades for a while, but not actually developing projects himself. You guys just sort of took it upon yourselves. How did you finance it, actually, is a good question, I think, as well.
With a private lender. So basically, there are lenders out there that would finance not only the mortgage part, but also the whole construction part of the property. And what they do is, I'm sure, Robert, you can kind chime in on that. But what our experience was, we got 75% off after repair value, and that was how much they were willing to
That's
to
great.
lend us.
That's great.
Yeah. So
That's great.
after repair value, they took on appraisers can do that, or they trusted real estate agents, depending on the lender. And so they have their professional who does the appraisal, and he gave us the appraisal value of 2.2 million. And so
So did that cover all your expenses then, as far as carrying the land and the build?
it did, yeah.
Amazing.
It did.
So you did it
yeah.
pretty much 100% financing.
Well, we had our own initial part of the down
Right.
payment, right? But when you think about it, yes, it's like it kind of gets put on the back burner, on the back end, right?
Right.
So you do get quite a bit above and beyond the 100% of the purchase price. Yes.
And it was like high end. I mean, and you know, like, these are nice finishings, right? This is a nice property. It's not.
Yeah.
It's like in a nice neighborhood.
Yeah, I mean, yes, there's a lot of custom built homes around. It's close to, it's on the west end. It's 5 minutes from the airport. So
Yeah.
for professionals executives that love to travel, and they have to travel a lot frequently, like airport is 5 minutes away, right? So on the other hand, downtown Toronto is not far.
Mm-hmm. And so that's like, of course, that's a very involved strategy, right? Like that's like, okay, we're going to go and we're going to buy a piece of, or we're going to buy a property, demo that property and rebuild. Do you think there was like simpler and broad, like whatever, I think, everybody can chime in here, but I would say if you had to tell people who are trying to get involved or start off in real estate with respect to investing, how do you think they should do it? Should they do that? Should they start to say, well, I'm just going to bet heavy and, I'm going to buy a plot of land? People who are not comfortable doing that, though, what would you turn to them and say with respect to getting involved? Like, how can they? Like, for instance, right now, I'm sure there's an opportunity for people to get involved with respect to what you're doing.
Exactly. So I feel like the best way to get started is literally partnering up with somebody who already been through the process, at least to a certain extent. You don't want to go with somebody who's super experienced, who's already doing it on it, like who already succeeded, because they don't have a need to share to share the bread, right, the dough.
Right.
But at the same time, I feel like partnering up with somebody who already been through it, kind of establish some systems in place. This is where it's a good way to kind of hedge yourself against the risks.
Right?
Yeah, I would say as well, if you're just getting started and you're like, I like the idea of putting sweat equity into a home, right?
Mm-hmm.
Sure. Yeah.
I mean, it sounds like you really increased the footprint of this place, and this was a big project, and I'm so curious to see it because it sounds gorgeous.
Yeah, we'll put some stuff up as well so that people can see.
I think that's great. But a great way to get started, and I tell people this all the time, is just find a single family home and convert it to a duplex. Is one of the easiest things, because like you would renovate your basement if you own your own home, right?
Mm-hmm.
Like I think most people have lived through that project or are willing to do it,
Mm-hmm.
So if you wanted to get into the investment space, I think that's a very simple way to get started. I know years ago, it was easy to get into real estate by buying condos because they were cheap. That's how I started. And, I think if you want to get into real estate these days, I feel like that's like a really good way to get in, because you can find homes at value, and then you can add an immense amount of value and income to a property by adding a second unit, and it's just as easy as getting a basement reno done. Of course, there's things you have to do properly. You got to do fire code correctly.
Mm-hmm.
Getting it registered with the city is a great idea because then it's a legal duplex. But like that is one of the best ways I feel of adding instant equity to a property. And then the best part about that is if you want to flip it, great, you can let go of it, and I think, these days with prices being adjusted as they are, and I mean going down, that we've seen, like if you had to hold on to the property at least for a while longer, now you would actually have two streams of income coming in on the property, which I think is like, brilliant, right?
Yeah.
And
Or you mean like if you rent? So that the assumption there would be you'd rent it out.
yeah,
Like,
if you
that's
had to
what
rent it out for a year to have the market adjust in your favor, which I'm telling you right now, a lot of people are doing that, right? They, if you had two income streams coming in, I mean, that's just adds so much more value, and you're able to probably carry that property and your expenses for that much longer until.
So this is like
right
house.
timing.
This is what they call house hacking, right? Where you take a house and you hack it up and you cut it into.
Well, I think house hacking is more about like
I'm
where
just
you
I'm
live,
playing
right?
the yeah.
It's-
I'm just
yeah.
assuming people don't know what we're talking about when we say cut it up. But what does house hacking mean?
House hacking is when you're buying a property for yourself, and then you turn it into a duplex, basically, and then you create a portion of the house to bring you some income to offset the expenses that you have on the property, right?
Okay. So
So
oh,
the
that's
benefits of that is that you get the mortgage at a cheaper interest rates, right? Because it's owner occupied.
Yeah. Oh yeah. Hacking
That's
up
true.
your own house.
That is true.
Yeah. Okay.
Yeah.
Yeah.
What
And
I've done on my last property that we're kind of still in the plans and in the process for getting permits, building permits, I actually rented it out by room.
Oh.
Yeah. It is actually like it's a raised bungalow. So we could have converted the basement as a secondary unit, but I decided to just simply go and rent it out by room. I feel like I actually decreased our risk even further because I have 5 individual tenants versus 2
In
Right.
the same
under
prop-
the same roof.
And that's
Right.
and then like you're able to drive more income out of the property when you do that, right?
Yeah, not necessarily, because you kind of need to need to include the utilities. You
okay.
need to include. You gotta give them internet, right? I mean, I could have given them, like, I could have made it in a way where they were responsible for, let's say, 20% of the utilities. But I just thought like this would be a little bit easier. And for us, it's kind of a temporary solution.
Yeah.
So for temporary solutions, this is something that is out there as well. Yeah, I've utilized it so far. Used successfully, no problems with tenants.
And again, I mean, that's something you could do if you have a property, like you're just getting in, you've got your feet wet semi in the real estate, like you own a property, and now you potentially could take that property, split it into 2 units, and have one of those units rent, and the other half be the one that's your primary residence, right? So you've got that house hacking strategy, you've got your duplex strategy where I like double income because then that's better. Especially if you don't have a lot of cash. I feel like that's, it's really a question of how much cash you have on hand, because the less you do have, I think it's like you've got to really start to drive cash as much as possible. So, I feel like
sure.
you and I were talking about the, Airbnb arbitrage sort of situation. I know Ontario, Toronto right now has a lot of restrictions on Airbnb.
Yeah, like, this is not really the market to get it.
Short-term
to get it
rental.
done.
Short-term rental is tough.
Cottage
right?
country, maybe.
Yeah, certain areas in Ontario are good. I guess I would say, Rob, you have some short-term rental. You're in that game, but if you were to turn around and say, I don't know, if you rented that out to someone, let's say, and that person was like, listen, I'm gonna Airbnb this out. I'll take it from you for 2 years, but I'll rent it out.
There's
as
actually
Airbnb.
laws in Ontario that prohibit them from making any profit on that.
It's
So
interesting.
The Landlord Tenant Act has rules around that.
Yeah, you
about
can't
subletting.
subtenant. You can't subtenant
You can't
out.
subtenant. You can.
It has to be 3 months, I think, is the minimum.
I don't know about the timing, but there's certainly a rule where they can't actually make money off of it. It's only based on covering their expenses, and that's with your permission as well as the landlord.
With your permission, but you should be with your permission anyway. I think it's with your permission.
You should be.
anyway.
Yeah, exactly. But you're right. I mean, there's certain markets that'd be perfect for that. I think about Florida. How about you rent a house out in like Orlando, right? And then you Airbnb that out, for example. Like I'm sure that's quite profitable, without a doubt. I got Disney on my mind, I guess.
Yeah.
But
I love Florida. I think it's a great market.
yeah, and I think but you're right. Like Ontario's tough. Airbnbs do well in lots of parts of Ontario for sure around the city. My experience has been a lot of people are passing through maybe they need some short-term solutions, between homes. I've had that quite a few times. I'm coming into town for work. I'm here to see my mom for a week. So I find it's more short, very short. People are a little more, I think, frugal too. But I have, small units. I think if you had a bigger home, you'd probably have a different crowd that would, and of course, location. I mean, like somewhere on the water, around Toronto, I'm sure could draw some people that are taking a bit of a staycation somewhere.
Are you finding it? We were talking just before the podcast about how busy it is, and you're saying there's slow periods. Is this a slow period right now? Are you finding there's a pattern with respect to periods, or is it
mine
not?
got slowed down a bit.
Yeah.
Yeah.
Is COVID, or is that not the issue anymore? It's more.
I think housing supplies is low, and the reality is people need short-term solutions. They don't want to tie up in a lease,
Sure.
And all that stuff, right? And I think Airbnb is successful because of that. I think COVID just enhanced it, if anything.
And working through Airbnb itself rather than you doing this. I mean, I suppose you probably wouldn't have thought to just do a short-term rental, vacation rental, without Airbnb as something.
Well, they're
as an option.
they're the Amazon, right? Like they're just the big giants in the field. There's other websites you can use for sure, but I mean, I don't know what the stat is, but it's like crazy. It's like 90% of short-term rentals go through Airbnb. So they were like first to market. They've done a good job, and I'm always getting requests to come stay. And my places aren't fancy. There's nothing too exciting about them, but it's just because there is the need for just people passing through or that short-term solution. The biggest three is I'm visiting family. I need somewhere to stay because I'm in town for work, and I'm in between places or situations, so I need somewhere to stay for like a week.
Let me ask you this: you think that there's different markets like we're talking about. Do you think that Ontario restrictions actually make it harder to invest in things like be creative with respect to investing? So, we have pretty strict restrictions. I think Ontario got really paranoid, and now we have like very strict Airbnb short-term rental restrictions. It creates an interesting, like you're saying, if you're, let's say you have no cash, you can't afford to buy a property. Now you don't have an option to, I remember when Airbnb first came out, people were doing it, right? People were in their rental, they were going on vacation and they would rent out their place.
That's kind of like actually the idea of how it started, I think.
That's what it's supposed to be for.
Yeah, exactly.
Right?
Like, I'm leaving town, let's have someone stay here. Yeah.
Right. And like now, though, do you think some of these restrictions are making it challenging to be an investor, or would you say you still have flexibility and, there's still some options? What do you guys think about that? Anybody?
Well, for short-term renting, it's definitely restricted. Like, you can only do half of the year, basically. Or you can only do a portion of the house. You can't even do a full house.
For a single family.
For a single family.
Yeah.
And it has to be a principal residence. So somebody needs to be living there and have it on the driver's license as a residence. And at that point, that person can be the operator of the short-term rental.
Right.
But at the same time, still, like, it's under assumption that somebody needs to live there as well, right? That same person needs to spend some time in there. So you can't utilize it year-round. So that's one thing, right? You can convert it in the slower months. You can convert it into midterm rental. So I believe it's still maybe a good option. If you don't want to commit to a long-term tenant.
You don't want to commit, but you can still have a 6 month. You can have something that's semi-long-term, right? Like a midterm tenant. Right?
Midterm rentals. They're under assumption that it's longer than 28 days, right? So you can definitely use that for certain months of the year, and then short-term rental when it's peak and good times, right?
Right. Well, look, if we shift gears a little bit and talk a little bit about lending. I just wanted to know, so you're saying that, your project was done with a private lender. And, but we've also talked about how on the other end of things, if you do have some cash sitting around, maybe it's not a bad idea to take your own money and put that money out to be lent and become your own hard money or private lender. And, you know, I don't know what your experiences are with that. I know that, Rob, you've been involved with this, so maybe we have some takes there. How restrictive or difficult do you think it is right now to take your funds and put them out onto the street? And is that a good option if you're looking for something to do? And how passive is that? Is it tricky? Not so passive? Is it simple?
Well, first off, there's loads of
And we can talk about the legal elements
lots
as well.
of demand. Like,
yeah.
Lots of demand. If you had $100,000 and you wanted to put it to work and earn double-digit returns, private lending will have that happen very fast for you. Like, there's so much demand. The investment market, investors, real estate investors, they like live on it. Like, Tina, you mentioned that's how you got your deal funded. I mean, this is happening everywhere across the country all the time. And it's not even secured mortgages sometimes. It's even promissory notes. And, that just means like, well, you know what a promissory note is.
Of course.
This guy's written a few promissory notes for me. That's for sure. But, those are, you're basically just making a promise versus having it secured against the property as a mortgage, right? So that market, again, is big as well. You get to probably charge a little more because of that. A little more elevated risk there. I can tell you right now from larger private investors, they're ramping up to do even more volume in business right now. So as a mortgage broker, we obviously have access to all kinds of different lenders. So mortgage income corps are basically just conglomerate of investors, people that manage or companies that manage
Mortgage. This is mortgage investment companies?
mortgage investment companies. So they manage sizable amounts of money that come from different varying private investors, even institutions that want to invest in private lending. And they are just ramping up and finding more money because the demand is there. So they're ready to put out cash onto the street. I find if you're going to do it yourself, I think there's a couple elements that need to be carefully investigated. First off, clearly the investment itself, the property, the people you're lending the money to, you want to vet them. Is there a possibility of this exit happening smoothly? Is your biggest criteria. You want to get paid, right? But the second thing is, and I always tell this to people that want to get involved in private lending is once you lend somebody some money, like you have to be able to know if they don't pay, can you take them out, right? Can you say, all right, well, listen, guys, I'm going to just take out this first mortgage and take over this project or this property. Because if you don't have the ability or the funds to do that, that becomes a challenge. Because you can imagine, for example, if you lend someone $75,000 and in second position, and the first position loan is TD Bank. Now, what will happen is if you're in second position and these people stop paying you, well, that means you're going to have to ask TD Bank to foreclose on them as well.
Yeah.
And
Absolutely.
TD Bank doesn't care, right? Like, that's not their business. They may get upset at the people that borrowed money against that behind them, and they may demand that that loan be repaid, right? They want their money back for their loan, but they're not going to, like, help you foreclose on them at all, right? So that becomes, like, a whole journey. So you have to be in a position where you can say, hey, times are tough for you. I get it. This didn't work out the way it was. I'll buy this whole situation out from your feet. There you go. And you won't get in trouble. You won't ruin your credit. You won't do it. But I'm gonna take care of this. So you need to have an ability to do that. That means you need to have access to capital. So you have to have some liquidity yourself. And you'd have to have enough income to support getting a loan of that size. So these are the things that need to be considered if you're going to actually privately lend yourself as a personal private lender. That's some things that I say this right now because it's not often explained well to people. And of course, with the rise of courses on how to real estate invest and hack. Like, I mean, online, people are getting involved in this, and I have come across this, especially in the last year, where, I took this on, I thought it was great, but now they're not paying me. What can I do? Can you help me, buy them out? And then we look at it and like, no, you're not in a position to do that. You should have thought of that in the beginning before you invested, right? So it's just something I think it's has to be said, like don't privately lend on something that you can't personally like achieve the goal of exiting from, or you're okay losing. So that's the other thing. Like if you're okay to handle a long drawn out process to get that money back out, to see that return come through, then that's fine, right? Then
So it's a long-term play. Is what you mean.
Well, that's the thing. Like, it could start off as a 6-month loan, but the honestly, it could take 2 years, right?
Yeah.
So it's not. So it's really strategic for brokers to even be involved with anybody. Like, so if you wanted to give me money that I can lend out to clients, like I have to certify you as an investor, right? So in Canada, that means you need to be earning at least $200,000 a year in household income, or have $1 million of liquidity, like have liquid cash.
Right.
So that just gives you the framework, right? Because if you're making at least $200,000 a year, then we'll probably find a lender to help you exit that if you had to. And then on the flip side, if you had $1 million liquid, then if someone didn't actually pay you, you'd be in a position then to take over that loan very quickly, right? So that's sort of the idea. So there's regulations around that as a private lender. But I have to say, it's a brilliant way to make a return on money, especially these days where it's hard to get those high yields, right? Like get double-digit yields, very difficult to do. Stock market, like who wants to even talk about that? But, it's a great way to invest for sure. I think you just have to know how much you can chew off before you get involved.
Yeah. Well, that's, I mean, one of the major things with it is you're a big player as a broker in that game, right? I mean, it's important that you do what you do as a broker. You make sure that in fact the property is worth what, that there's proper appraisals done that in fact, and I know Tina, you want to push back on that issue, but there's a handful of things a broker has to do, and the broker obligations are sort of separate from the legal obligations. A lot of times people will just come into my office and say, hey, I want to put this money out on the street. I'm going to lend this person this money. I like it because I'm like, I'm kind of bullish on the idea of you getting involved in the market, taking risk. I understand if you're prepared for that risk. The problem with that is that I may not know that we could get that money back out if there's no appraisal that we have or that we can turn to. Right. Some of the other issues, of course, like a promissory note is an interesting thing. Yes, it's a binding contract, but it's not certified or secured against any property. So we're sort of stuck in a situation with a promissory note where if something does go wrong, the enforcement mechanism to get it's not to say that you couldn't enforce. You could enforce. The problem with it is that you're really into a place where we don't have security against the property directly. You may have it later, you may have it eventually, but you don't have it when the money is sort of on the table, right? Like
Is the only
right?
mechanism through courts, I guess? Is that the idea?
Well, no, I mean, to get you would get to the court to do a proper enforcement if you're going to do it that way. The reality is the way that this stuff pans out, most times it's negotiation, right? Like
Right.
At the end of the day, you're going to end up calling that borrower to say, hey, what's going on? Do you have a lawyer that we can speak to figure out if we can get this sort of worked out before we put you in default? Putting somebody in default, right, creates a serious situation. Now that person has to, adhere to whatever. They have to. There's a handful of things that have to happen, right? It's a very complicated process to enforce once you're really down the formal requirements to enforce. But the short answer, or the short sort of way in which we deal with that, is to ensure that we have a flexibility. You have to, as a borrower, given that this is not a traditional way in which you collected money, have flexibility. Be prepared to talk to a lender, a lender's lawyer. Be prepared to say, okay, I'm prepared to make a negotiation, because what happens is when that communication gets cut off, that's when you start to end up down the formal channel. And that formal channel is pretty bad, because once you're at the 45-day mark, you're basically going to be in court. And, of course, a lot of lenders like to say, well, yeah, but you could you could void that notice quite quickly. All you got to do is pay some of the money. True enough. There are mechanisms to void the notice given by a lender, but it's a very formal process. It's a bit of a headache. You should have a lawyer on board, which usually, if you're in that state as a borrower, you probably don't have, right? So the hope would be...
Sounds expensive.
Yeah, it is expensive, right? It is expensive. So it's expensive. I would say that's where, as a lender, you want to have proper mechanisms in place to ensure that there isn't so much risk. Of course, that what's going on there is a bit of risk, but how can you mitigate some of that risk? I think it's important that you have some mechanisms to stop that risk from happening. That's my thought on it.
For sure. I feel like you, in a private lending world, start small if you can't afford to lose the money. And once you build it up to the point where you can actually hold the property and finance the whole property, that's when you can start expanding and looking at different vehicles where to invest your money in a private lending space. But aside from that, you can also be a joint venture partner, right? So you can be a little bit more heavily involved in the process to make sure that the person that you're lending money to is not just abandoning the project, right? And so you kind of are more hands-on, but it protects your investment.
What a great way to build a relationship too, though.
Yeah.
Being a joint venture, right?
Yeah.
Because then it can convert into lending. There's this trust that's been built through the grind of doing one or two deals with each other. I think that's great idea.
I feel like that's really the key.
Yeah.
So listen, I mean, we before we stopped for a little bit, we're just talking a little bit about private lending. I want you to sort of tell us again what you think with respect to getting involved in private lending. I know you talked a little bit about risk in private lending. Is it a good strategy? So it is a good strategy if you're thinking long term. Was what I remember talking about.
I think it's a great strategy, and I think using joint ventures to get started is a really good idea. I mean, I know I kind of started that way as well, and starting off small to Tina's note is a great idea as well. Helping people out, is a great way to go as well. Like some people just might need a short-term loan, say for a deposit, for example. Like that's a private loan that you can lend to somebody. You're helping someone and if you feel like they're going to pay you back, then that's a great way to start, right?
But that deposit is that's what we were talking about. With private lending, what I would say is, the promissory notes, how do you make a decision that you're going to give someone this deposit? I know it's like we've had conversations about it where you're sort of like, I know them. I'm like, oh, okay. Or like, I don't know them, but like I feel good about them,
I think, you have to judge the circumstance.
Yeah.
Right? Like, the reason why they may not have the cash available right at that time is probably your biggest signal as to if you're going to lend to them or not.
Mm-hmm.
Right? Because 0 minus 0 is always going to be 0. So, but if you have equity tied up somewhere and you're just like, okay, it's just timing.
Yeah, like a bridging or something.
Yeah, exactly.
Like this, right?
It's just a matter of time. So, I can lend you this money because I understand the timing isn't there, right? But once that property's sold or your investment finally opens up that you're waiting for at the bank, like whatever that is, right? Then, you can see that end point where then I will lend you that because I can see exactly when I'm going to get my money back.
Right.
And it makes sense.
And then you're looking less at ratio, right? Less at like, okay.
When
like,
you
you
get
don't
into
care
private
about that.
lending, all that kind of just moves right out of the way, right? Like big banks are looking at those types of things like debt service ratio. So just meaning like how much income do you have versus how much debt that you can service. It's something like it should be definitely under 50, percent, that kind of thing. But the truth is, when you're lending on a private level, it's more about equity, right? It's more like you become an equity lender. I'm sure that's, been thrown around a lot. And the idea is that you can see maybe in the future, for example, like Tina's project, like it was an after renovation value. So you got money, right, based on the fact that what your work was doing was going to improve the value of this property. So it's purely based on equity. It wasn't based on your day job, and all private lending, for the most part, that's the way how it works.
Yeah.
Right.
I can give another example of private lending where it doesn't have to be short term unless you need money short term. A lot of investors, they love the fact that it's so passive. But if you're analyzing deals every other month, it becomes very active because you need to build a report with your people that you're going to lend money to. And so, and then you need to analyze the deal. So go through the process, signing paperwork, right? There is quite a bit of not quite a bit of work, but if you're doing it every month, now it's work heavy. So from that perspective, I can give an example. I was looking at an investment property in Texas as a short-term rental strategy. There was enough cash flow for me to bring on an investor who will completely cover, in the second place, down payment necessary and the furnishing for the project. So basically, it would be zero money out of pocket for me as an investor. I brought in a lender. The cash flow, projected cash flow, was enough to cover the first mortgage in first place, him in the second place, and still give me money on top of that.
Amazing.
That's amazing.
Yes.
But also, in a place like Texas, I would think that rules with respect to second place, because that's the other issue, is the second position. So when we're talking about second position, what are we talking about? You have the first mortgage, right? You might get a big major bank to give you the main
cheaper rate
down, the main remainder of the funds that you need to close. Then the second position would be, okay, you need additional funds for whatever reason. It happens to be, in this case, you're saying using it for down payment funds, like whatever else. Furnishing, which is interesting, right?
Yep.
Yeah.
I mean, I feel like that kind of flexibility, there's not a lot of that flexibility from a big bank definitely in Canada, not the case, that a big bank would go in second position to give you money for down payment and for furniture in a house. Not a chance, so that's when you see the value, like the true value of having that option available, right? So from your perspective it's kind of cool because from your perspective as an investor versus your perspective as somebody who's dealing with the banks and is also saying, well, we've got, private funds available if you can't do it, you really see that's the way in which you can get things done. And, bad market, down market, good market, it sort of almost doesn't matter. The issue maybe, I mean, the one issue there is, it's more expensive in a bad market. Like right now, I think like a private loans are pretty high in terms of interest, but everything is kind of higher. There is a stability coming. We can see that.
You know what the irony about private loans are? Not really. They're always kind of around the same price.
Really?
Yeah. The banks
I don't think I knew
will
that.
Fluctuate, right?
Yeah.
Because they're borrowing money from the Bank of Canada, so like literally, and they're buying bonds to fund that's literally how they fund their mortgages. But private lenders, I mean, for the most part, when times were really cheap, I guess maybe it got a little more competitive, but I mean, I've never seen a private loan less than like maybe 8%. I've seen maybe 7 before, but it's a game of fees. Like everyone wants double digits, right? So like all these private lenders, even if you're in first position, they're probably maybe even if it is as low as 7%, you might still be paying like a 3 or 4%, lender fee right up front, right? So just things like that. That'd be definitely in first position. Second position loans, I mean, they always start at like 12%.
Yeah.
I mean, I've been doing this
and you're saying
for
like
9 years. I've always seen it.
And that's not like doesn't matter so much about what's going on with Bank of Canada. That's sort of stable.
No, because it's a security thing as well, right? Like if you're asking for more risk on type of lending, you're going to pay more. Like, I've seen them as high as like 18 or 19%, for lenders that I would say would warrant it. They're very challenging situations.
And they're just looking for cash flow out of the property usually, or are they looking for?
Yeah, from an investor perspective, I mean, I think most investors wouldn't want to pay that. I was more referring to like a borrower that was just more in a tight position. From an investor perspective, I think in second position, there's so many ways to get deals structured as well. Like, if you're flipping, for example, you can pay for payments up front, right? You could actually build your payments right into the loan, or it could be a balloon payment after it's sold, right? And those types of flexibilities, they would charge more for that, right? But it's like non-existent anywhere else. Like, you can never get an institutional lender to probably do something like that for you. Like, once you get really creative on the private side, it's usually a one-on-one investor. So I'm the investor in the property, I'm the investor as the lender, and you guys are working something out.
So that's
that makes sense maybe for your deal, right?
That's
and that's where
JV
relationships come in.
Oh yeah, okay, and that's JV.
I think with the JV,
Yeah.
JVs help bridge the way to some of those things, right? Because I've certainly done things like that for people, but I had that relationship already, and some of those relationships started as joint ventures, right? So I think it's really important to build that relationship. We were just talking during the break about being an investor is being a business owner. Like, if you're getting into real estate investing, you should write a business plan. You should be able to articulate how you're going to get things done, who you're going to use, why you're in this particular market.
What kinds of projects.
And then when you have that in place, then it's easier to go ask someone for money.
Sure.
Right? And so, obviously a very popular thing. It's always been popular, but I feel like it's even more popular now, is buying property without any of your money, right? And you just touched upon it in Texas. And oftentimes that works out when you've already done the due diligence of building a plan, because then once everything's set in place, the investor is just a phone call away, because they've already said, yeah, I'll work with you because you have this worked out. I find new investors don't often get that point until they try to do it, right? Like,
Sure.
they I have something on paper, I have an agreement. Then they call me like, hey, do you have all the money? I'm like, no, I don't have all the money. Like, you need to build this out, and then you could start building those relationships for yourself, right? Like, you could start with family and friends and approaching them about their RSPs and their TFSA.
And say, hey, you should do it.
Yeah, you can use those funds to invest in real estate directly with me, and you're going to make interest on your money. It's going to be tax-free because obviously you're going to use those instruments. That's super popular. But, of course, you're going to build that trust with a plan, right? So I think it's really important. And, Tina, I think you could speak to that. I mean, you're, a professional doing this. It's all about having a plan, right?
Yeah, I mean, it is. Investing is, in essence, a business in its own, right? So it's one thing that everybody needs to analyze is how much time can you actually devote to your investment. It's a side gig to get started, right? But as you start scaling, you realize that all these properties they require more and more attention.
Sure.
So sometimes that's why I say sometimes it's just easier to partner with somebody. Now you kind of conquer and divide, right? Divide and conquer. And in the amount of work that is needed, the attention that is needed, or different markets, and you can basically spread out the risk that way, right? If you tackle two markets at the same time. But from the side of bringing on investors, if you're just a rookie or a newbie in investment world, you want to start, let's say, flipping homes. Obviously, people are going to ask you, what have you done so far, right? So having somebody who's already been through it, and now you kind of have a partner.
Yeah.
Like now there's a track record that you can kind of rely on, even though it's not your track record, it's somebody else's. And now when the lender comes into play, they will feel more safe that
Right.
there is an exit plan, there is something behind it that will secure his money, right?
And if you've got a plan, so like, again, like if the plan is, hey, I'm going to find other investors that have a portfolio of some kind, or they've been involved, and that's part of the business strategy that you've chosen, then yeah, I mean, I can see how that would work. I would say, do you think as well, though, you should have your own, like, I mean, you should have write a business plan to get going, or do you just say, okay, I'm gonna go ahead and do this, you know?
I don't think it's necessary to write a business plan because you don't know what you don't know, right?
That's interesting.
Sometimes
Yeah,
you just
that's
gotta
true.
immerse yourself in it, right? But don't overstretch your abilities. So
I think that
if
could
you
be a
don't,
business plan right there.
yeah,
It's
Don't
just
overstretch
what
you.
are my abilities? Like what do I have right now to work with?
Yeah.
How do I do the best with what I have right now, right here?
Yeah.
Right.
Yeah.
I think that is a business plan. In essence, that's
Yeah.
what it is. And then you sort of develop that over time, right? Like I'm sure your projects got more sophisticated because you executed, you learned, right? And then you're like, how do I improve? How do I do better? How do we grow, right? And then you're just constantly doing that. And I mean, that's in essence, you know, we're all
Yeah.
entrepreneurs. That's what business is. That's what is an active business plan, right?
Yeah.
So, you know, I think it's so important. I'm curious if you had to have a dream partner, a joint venture person, or a lender. I mean, what do you really look for?
You know, when I started, I was looking strictly for silent investors. And now I was thinking that's the only thing I need in order to succeed. But then as we went through the process of building and then trying to scale at the same time and getting into more properties, I realized there's the time limit. And the time limit is so important to evaluate, right? So now at this point, my dream partner would also be able to contribute to the success of the business, right? Of the investment business. It doesn't matter which strategy you take, or you can take on multiple strategies in your business, in the investment business, right? So at this point, I'm looking for people who can bring on value that I'm not an expert in. I need legal advice. I need lenders at my table, right? I need people in construction side who can do multiple things, right? So this is where I realize and even on the admin work, like sometimes I don't have time to do it, but it has to be done.
Yeah, so it's so important to build it out with a team.
Yeah.
That's interesting. So you're looking for some pretty active roles there, right?
Not-
That's a team, right? Which is
Yeah.
good. I don't think you can build it out without a team. I think if you don't have those things in place, then yeah, that's good. And then offering members of that team the ability to say, hey, you're getting involved. You're going to help me. Sure, I'm not just going to pay you a fee though. You have an opportunity to invest. You have an opportunity to get equity out of what's happening.
Exactly.
That is, that's
Rewarding.
appealing.
Yeah.
That's appealing for people who are looking to get involved. It is, I would say that means it's not for everyone, right? That means that you've got to bring something to the table and be prepared to contribute in that manner. And then in exchange, you do get equity. And so that would be the base of what you're building out.
But there's so many different ways to immerse yourself
Yeah.
into the project, into transaction, right?
So you're right now not looking for the ultimate passive investor, somebody to just give you money, as an example. I'm sure that would be helpful.
Yeah.
But
yeah. But
it's
you know
like
what? I realized that there's not really, sometimes that's good because you want to be in control of the project. If there's too many people trying to control a project,
Sure.
it's hard.
Sure.
But at the same time, sometimes having another person to back you up when you are unavailable or get sick or, you
Sure.
know, like
Yeah,
when
life happens,
life
right.
happens and you kind of need somebody at the same time property needs the attention, then it's nice to have somebody else who can contribute on the same level. And we all have our benefits and advantages and disadvantages, right?
Correct.
So from that perspective, I feel like almost everybody have something to bring to the table.
Yeah,
You can either analyze the deal and find me a next flip that we can get into. You can maybe you don't have capital, but are you a worker? Can you get a mortgage? Sometimes a small mortgage is all I need to get myself a next flip, right? Sometimes you have a down payment, but you don't have down payment. So like capital, but you don't have mortgage abilities. There are so many different ways where somebody can kind of help out in the project and through the
And a
project.
big part of what you do, though, is source property, though, right? You would
Yeah.
help with the sourcing of the property,
That's right. Yeah.
right?
That's
And
How do you find your properties?
Yeah.
Like how
Actually,
did
that's a
you
good
find
question.
your last one, for example? Like how did that work out?
it was at the time I didn't have my license yet, so the Radburn project is a recommendation by our real estate agent at the time, and we're glad we got it. There's off-market sources. Facebook groups are a great way to find off-market properties. And then there's also on-market. There's still ways that you can find on-market deals. You just look for
So you
something
wouldn't
longer.
necessarily you didn't need a realtor to do it necessarily. Like if you were going to get involved, or you're going to do that, try and source property.
Yeah, the only challenge that people who do not have access to MLS, they can't look at the comparables, right? To really evaluate, okay, is this asking price really a good under market value price?
Right.
And or how much should I bring it down?
Sure.
Or, is it worthwhile buying at the market value?
Mm-hmm.
Yeah, because sometimes the market value is still a good deal. Because if it's a cash flowing property, you're buying cash
Right,
flow.
yeah, it's you got to look at it with different eyes, right? Different lenses.
Yeah, different exit
just
plans.
Like you're buying a house for yourself, right? For sure.
Yeah.
And that would be, but that's where it gets tricky though with big, like that's how it's hard to get financing, I would say, in that it can be, or traditional financing, right? So you do have to, traditional financing is really where they would be, looking at things like an appraisal to figure out whether it's a good idea. You've got GDS, TDS, all of these things that have to sort of
Right.
build a picture that makes sense.
That's
It can be quite difficult, right? In the case of, in a circumstance like yours, where you're saying, look, we're trying to do something a bit more creative. It's more development based. It's investment oriented. I don't know. What do you think about thoughts on appraisals?
I think the private market space is literally created because of that. Like
Yeah.
literally, right? So we just got to keep that in mind, and people need to embrace that. And I think a lot of people get squeamish when they hear about the rates, but you really just have to factor in that to the cost of the opportunity, right? And just crunch your numbers. Does it make sense? Because you will have to carry.
You got to
loan,
carry it,
right?
Yeah.
yeah.
I think creative financing is the only way really to get this stuff done, right?
Yeah.
I have plenty, or I should say plenty, but a handful of lenders that will do 100% financing. Like that exists, for flippers. But, they're not necessarily cheap. Sometimes to get it cheaper, you securitize against other property. And this is why it's really important, I think, to own your own home. And I say that a lot to people. I encourage first-time buyers to get into the market because this is what it's about, right? It creates opportunity for you. Like, okay, you can move up one day and get a bigger home. Like there's that traditional way of thinking of things. But like if you want to get into, let's say, flipping homes or buying property,
In any market.
holding, yeah, like in any market, and you want to hold on to property and build and scale, like your biggest asset will be a house you own because you can leverage against it. You can use that leverage to blanket other properties. So if it is a flip, you can get a better rate usually because of that. You can also even just use that money to help you put down payments or construction costs on new investment properties you want to hold. And the best part about all that is that is all tax deductible. That's all something that you can basically use as a tax deduction in perpetuity, like forever, just as long as you have that investment that's still there. So unlike your RSP that you have to like shovel money into every year, right? Like you don't need to do that for this. Like you made that investment and it could self-service itself. So if you structure it properly, and then there's a whole other like gamut of things that, you could do with the rental income as it comes in, and you can, this is the Smith maneuver stuff that, this is where like, the bread and butter of the Smith maneuver comes into play, is because you can create a tax deductibility in your own mortgage, and it could stay there with you forever as you're generating all this extra income. You get this tax deduction for as long as that asset and investments are still out there, which is gold. Like people don't realize like how good that is,
Sure.
and you can build that out. And so, I think the private lender space is great. I think you actually asked, sorry, I went on a tangent. I think you asked me about appraisals. Man, appraisals are my life. I do a lot of appraisals. I was just reading a really interesting one before I got here today, but appraisals have been challenging over this last year, to say the least, right? When times are good, appraisals are easy, right? Like, when prices are going up, it's always easy to get an appraisal done to work out because there's that expectancy. When the prices are going up really fast, it can also be a challenge as well, because sometimes you're buying at the premium because things are moving up and the market hasn't necessarily caught up, right? You got to remember, appraisals are all about comparables. So if the comparables are from like 2-3 months ago, but you paid an extra 5% because that's where the market's gone in that neighborhood right now, sometimes that can be a challenge. But I'd say the last year's been the opposite problem, because prices have been moving down and appraisers are very careful, right? They're very careful and they use terminology inside the reports to discuss the market conditions. And so that in itself creates doubt with lenders. And I've seen that quite a bit in the last, I'd say, 6 to 9 months, where they're commenting on the fact that this neighborhood has a trajectory to go down. This area has gone down by so much already. We could forecast it going down further. So even though the value, let's say you're looking for is $1 million, you got $1 million, all of a sudden, the bank may say, well, I may want to lend less. Right? Like, so we've seen a lot of that happen. Investors definitely got caught up in that for sure. But again, that's traditional lending. I think when you're getting appraisers with private lenders, they're focused on exit more than they are with current value. So I think that's something to keep in mind as well as an investor.
Yeah, if I can add to that,
Yeah.
I mean, what's challenging about appraisals is that there's, in a down market, there's a lot of price discovery that happens. So it's not really that the value of the properties across the board, let's say on a certain street, are now being determined by the comparable. Because it could literally mean that just that person was really willing to let go of all of the majority of the equity that he had, because he's in a distressed situation in the moment because of rising rates. So the one neighbor decided to sell for a lot cheaper than what the market value would be.
Yeah, that drives the price in the neighborhood down, right?
Right.
Yeah,
Yeah.
Who are
that's a really
desperate.
good point.
It's like
desperate.
we go through price discovery. I think that's what Ontario or Toronto has seen in the last half a year. It's a price discovery. You see one property, neighboring properties, one selling for $300,000, $400,000 less than neighbor next door. And so I've seen it actually. And so I feel like that appraisers still have to be very careful what they do in their reports from the liability perspective and possibility of getting sued. Mm-hmm. And that's another challenge that comes with appraisers or appraisals, is that
They have self-interest.
it's a little bit of a conflict of interest, if you're asking me.
Yeah, they do. I mean, they have, of course, absolutely. Because it has happened. I mean, appraisers do get in trouble. They get dropped off lists and stuff. And
I didn't get an appraisal. Appraiser did not gonna give me an official copy of the report because I wanted to put a second place loan for the construction on the property. And he said, you're gonna be 100% loan to value, and I cannot give you my report.
That's a weird kind of conflict of interest situation. I
That's
feel
what-
that's
that's one of those things.
That's a judgment call and a kind of a foolish. Like, I understand the worry for the appraiser, but that's a bit. Now you're doing a disservice to your client, right? Right. Which is, tell the client that they can have. I said to you before, I think we talked about this. Give them the report and say, look, don't sue me for anything, which is okay to do in writing. You can 100% do that in writing.
Yeah.
But I think that's what it is. So I think the error there is that you just put it in writing in the report.
Yeah.
This is to be used for ABC lender only.
Yeah.
Right?
Yeah.
Like any other uses, this appraisal report does not support any other uses.
Yeah.
That's usually the verbiage there, and that's usually a conversation you just don't have.
Well, Yeah,
You know,
that's
I
for
mean,
sure.
that's sort of the trick of the trade, right? Like sometimes you're just like, you know, you give me the report, I paid for it, okay, cool. Then there's the whole conversation: who owns the report, who it's addressed to is usually the owner, right? And that's
Yeah.
a whole, because I get clients all the time, like, I want a copy of the appraisal. I'm like, the appraisal doesn't belong to you, you know. I'm sorry,
Yes.
but it doesn't. And then the challenge around that, you know, there's a lot around that. I mean, there's a privacy issue because there's comparables and other people's properties and details about
Sure.
that property there. So there's a lot of other reasons, right? Besides the ownership issue.
Yeah.
But yeah,
One thing
Yeah.
I say is that like I that's why I feel like people should be less reliant on the systematic way of doing things, which was done in a way where it's so foolproof and easy for us, especially in a good market, right? Like you rely on your appraisal, which usually was coming as at good. You would get the bank would give you a loan, no problem, right? And now that things are challenging now, even though person to person, buyer to seller see the same value and agree on the value, the deal falls through because the appraisal doesn't come in and the lender won't give money, right? So if we encourage people, and that's what I've realized, especially since I started exploring the U.S. market, is peer-to-peer lending and exploring that as an option really actually will create more deals to be happening and more people will build wealth that way, right?
For sure.
Yeah, that's a valid point. I think you're absolutely right.
So, guys, I'm mindful of time. Before we go I feel like that's a topic that we can have a whole podcast
Oh, we
on.
could.
But
think
what I would
speak
say
about
is
that,
this.
for sure.
I just want to touch on very quickly. Lastly, there's going to be an event that we're going to be hosting. The three of us, I think, Rob, you're coming on board now.
Okay,
We
I'm
didn't
coming
make-
now. I
He's
don't even
coming.
know what's going
We're
on, but I'm
saying this
going.
publicly. You're coming on. We're going to throw an event. Part of that event is going to be a semi-launch to the project that Tina's been working on. We're going to discuss what that is. We're hoping to get some investors together, get people on board, just thinking about real estate, networking if they want to get involved in projects, to talk about them. You know,
Build
different
trust.
markets, not just Canada. There's going to be, you know, there's going to be some nice scotch there. We're going to try and put together some nice food. It'll be a nice event, and we're going to host it at one of Tina's properties. So, you know, we're gearing up for March 30th, and we would hope that everybody would want to come out to this. Tina, is there anything else you want to say about this? I think that it's you know, I'm pretty excited about it, and you know, we're still putting together a lot of the pieces and parts, but if there's anything else you want to add there,
Yeah,
let me
I
know.
mean, definitely people will get to see and touch and feel the property, the project, and how we go about things. But not just from that. Like I feel like putting investors in a room and building that report so that you can take on different roles, right? From a lender to an investor to active to passive. So this is in the room. This is where it happens.
Yeah.
And then when you're in a big investor summits where I've attended lately, when it's too big, you can't do any of that. There's not enough time. You get lost in a sea of other people. So we're doing it intimate. We're doing it small. And for a reason, I feel like this is where deals are going to be happening. So
Absolutely.
join us and let's get to work.
Yeah,
That
and
sounds great.
that's
I'll
what
be
it is.
there.
It'll be like, yeah, I mean, and it's we'll you know, we're going to keep it small. RSVP, we'll open it up within the next week or so, and yeah, like if you want to come out, you know, of course, come join us. We'll talk more about real estate. But hey, I think this has been a great podcast. We're sort of at the end here. Just want to thank Tina for coming on
Thank
and
you.
sharing her thoughts on investing. You know, of course, we'll come back. You can come back on, and
Oh.
we'll do this again at some point, right?
Definitely.
And Rob, always a pleasure. And, you know,
Of course.
looking forward to the next one, guys.
Absolutely. Thank you, Tina.
Thank you, Rob. I appreciate your insight.